Okay, let's unpack this. Have you ever looked at the world's most successful investors and thought, how do they do it? Is it luck, genius, or, something we can actually learn? Many people call their success a 5 sigma event, a statistical anomaly so rare it almost never happens to be precise. It's like a 1 in 3.5 million chance of happening. But what if one of the greatest among them, Warren Buffett himself, says his methods are not beyond anybody else's competence?
And that's precisely the core tension we're diving into today. Our mission is really to explore the fundamental principles that have guided Warren Buffett's, unparalleled investment journey. We're drawing directly from Robert G. Hagstrom's seminal work, The Warren Buffett Way. We'll distill his immutable tenets, we'll examine how he applied them in, real-world investments, and maybe most importantly, confront the psychological traps that so often derail even the smartest investors. This isn't just about what Buffett did, but why he did it, and crucially, what it means for your approach to informed decision-making.
Right. We're working with comprehensive excerpts from this seminal book, which really breaks down Buffett's philosophy into digestible, actionable insights. From his earliest lessons, his influences, to his most famous acquisitions, we'll see how a consistent, rational, and importantly, patient approach can lead to extraordinary, enduring results. So let's begin our deep dive into the Warren Buffett way. Kicking us off, let's confront this idea of Warren Buffett as a 5 sigma event. The prevailing academic wisdom, particularly from the Chicago School and its efficient market hypothesis, suggests something, pretty radical, that you can't beat the market.
Yeah.
Their reasoning is that all available information is instantly and perfectly reflected in market prices. This makes consistent long-term outperformance practically impossible because every asset, theoretically, always trades at a fair risk-adjusted return. Yet, Buffett's record, along with a few other legends like Benjamin Graham, Peter Lynch, Stan Druckenmiller, George Soros, Julian Robertson, their performance just seems to fly in the face of this deeply ingrained hypothesis.
Precisely. From an academic perspective, calling Buffett a 5 sigma event is their mathematical way of explaining away his consistent multi-decade outperformance. It suggests it's not repeatable skill or some learnable methodology, but just an extreme outlier, an anomaly so rare it borders on the miraculous, However, Buffett himself dismisses this. He famously stated, "What we do is not beyond anyone else's competence. I feel the same way about managing that I do about investing. It is just not necessary to do extraordinary things to get extraordinary results."
Right.
And that's the central question we're exploring today, isn't it? Is his genius replicable, or is it just sheer luck? And what does that imply for your ability to find market inefficiencies and apply his wisdom?
That's exactly it. If we accept Buffett's claim that it's not beyond anyone else's competence, what does that mean about the efficient market hypothesis? Is the EMH just wrong? Or is Buffett operating in a different dimension the theory doesn't fully capture? So if it's not pure luck, where did this unique competence come from? His formative years clearly played a massive role. He was intrigued by stocks and finance from a very young age, often called a money changer. He was a frequent visitor to his dad's brokerage office, apparently bouncing down the stairs to the Harris Upham firm, where brokers let him chalk stock prices on the blackboard.
Yeah, imagine that.
And he even delivered both the Washington Post and the Times-Herald on his paper route at age 13, long before Phil Graham bought the Times-Herald. But his childhood wasn't just idyllic. His father losing his job due to the Great Depression deeply impacted him. It highlighted the fragility of financial security and really set a lifelong aversion to financial uncertainty.
That early exposure, combined with that profound experience of financial insecurity during the Depression, it really laid crucial groundwork for his disciplined approach. Think about it. At just 10 years old, his father took him to New York. It was a birthday gift he gave each child. Other kids might want toy stores, right? Buffett told his dad he wanted to see the Scott Stamp and Coin Company, the Lionel Train Company, and, significantly, the New York Stock Exchange.
Oh, at 10?
Yes. He was utterly mesmerized by meeting Sidney Weinberg, a senior partner at Goldman Sachs, who was then considered the most famous man on Wall Street. He remembered it forever. And then at 11, he learned one of his most crucial early lessons in patience. He sold Citi Service Preferred stock for a small, $5 profit, only to watch it soar to $202 a share. He missed out on over $492. Big ouch. He calculated that was equivalent to 20 years of his savings at the time. From that moment, he swore he would never again be sidetracked by a purchase price or settle for small profits. This early lesson in patience, it's a crucial theme underpinning his entire philosophy. That quality he emphasizes is paramount for long-term success, especially when you consider the temptations of quick gains,
It's incredible how those early experiences shaped him. And even later, despite his father's insistence on college, Wharton didn't really turn him on, did it? It focused heavily on theoretical aspects, and he craved the practical, the how to make money side of business. He found it unimpressive, transferred after 2 years, eventually graduating from the University of Nebraska. This really points to his inherent business-first mindset, a theme we'll see consistently prioritizing real-world understanding over abstract academic models.
Indeed. And Buffett's investment philosophy isn't some singular monolithic idea that just sprang fully formed. It's really a unique synthesis of insights from three powerful figures: Benjamin Graham, Philip Fisher, and Charlie Munger. Too often, people only credit Graham as his sole mentor, but it's this distinct blend of influences, of true intellectual trinity, you could say, that really makes Buffett's approach unique. It sets him apart from others who might have studied Graham's work in isolation.
Okay, let's start with Benjamin Graham, often called the Dean of Financial Analysis. His book, Security Analysis, co-authored with David Dodd and published back in 1934, and then The Intelligent Investor from 1949. These became foundational texts, especially after the devastating 1929 market crash.
Right, and Graham himself was financially ruined by that crash, which profoundly shaped his ideas.
Yeah, you can see how. He helped people regain financial footing by defining investment, not by the type of security like stock versus bond, but fundamentally by intent. As he put it, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative.
Oh.
This simple but profound distinction was central to his teachings. It emphasized thorough research and capital preservation over, well, just gambling.
And his most crucial concept, the one that deeply resonated with Buffett, was the margin of safety. This meant buying assets for significantly less than their intrinsic value, whether it was due to overall market lows, temporary industry struggles, or simply being overlooked by others. It's like buying a dollar bill for 50 cents, essentially. Graham's methods were highly quantitative. He focused on tangible hard assets, consistent earnings, reliable dividends, largely ignoring the qualitative stuff like management quality or specific business nuances.
The soft stuff.
Exactly. He famously saw cigar butts companies so cheap, so beaten down, that they offered one last free puff of profit, even if the business itself was, frankly, mediocre. He tested stocks, found that buying companies at a 10-year low price-to-earnings multiple, or at half their previous market high, with some net asset value, that proved promising. He believed the market frequently mispriced stocks due to human emotions, fear, and greed, and that eventually these prices would revert to their true value. This provides a natural cushion against unforeseen events and miscalculations.
Then you have Philip Fisher, who, in stark contrast to Graham's quantitative focus, centered on qualitative factors. He wasn't as concerned with the stock's current cheapness as he was with the company's future prospects. Things like its research and development pipeline, the efficiency of its sales organization, cost controls, and importantly, the integrity and capability of its management.
Huge difference.
He believed truly understanding a company meant more than just analyzing financial reports. It meant doing scuttlebutt, basically, gathering information from people intimately familiar with the business. Customers, competitors, suppliers, former employees, getting that deeper, more nuanced, often non-obvious understanding of its real strengths and weaknesses. This was pretty revolutionary at the time, going beyond just the numbers.
Yeah, while Graham focused on cheap stocks, Fisher sought superior companies with long-term growth potential. He was willing to pay a fair price for quality because he saw their long-term value appreciation and compounding power. His emphasis on sustained organic growth and particularly on avoiding equity financing for growth, meaning companies should generate funds internally to sustain growth without diluting shareholders, that highlights a key difference. This focus on enduring quality, strong competitive advantages, and capable management. It was a pivotal addition to Buffett's evolving framework. It moved him beyond just cheap into thinking about great.
And then came Charlie Munger, Buffett's longtime partner and intellectual sparring partner, you can say. Munger significantly pushed Buffett away from the pure cigar butt approach. He urged him to look beyond just cheapness. Their purchase of See's Candies in 1972 for $25 million, which was 3 times its book value, that was a truly pivotal moment in Buffett's journey.
It's absolutely critical.
Buffett himself acknowledges this as the first time we paid for quality. It taught him a profound lesson about the power of brand and pricing power. He'd been initially skeptical of the price, apparently, but Munger convinced him of the long-term economic returns of a great business that could consistently raise prices. And Munger was right. 10 years later, Buffett was offered $125 million for See's, which he famously declined, knowing its true value and compounding power.
Munger really helped Buffett appreciate the immense economic returns of buying and owning great businesses, even at a higher price, rather than just cheap, mediocre ones. It was a shift from buying fair businesses at wonderful prices to buying wonderful businesses at fair prices. That's a key distinction. He also educated Buffett extensively on the psychological missteps inherent in financial decision making, setting the stage for a more rational, less emotional approach. Munger often used vivid analogies like the racetrack analogy. Finding a good horse at inviting odds is key, not just betting on any long shot. He emphasized that even highly intelligent people can make irrational financial decisions due to cognitive biases, and understanding these biases is crucial for consistent success.
So Buffett's genius, then, it truly lies in integrating Graham's margin of safety theory with Fisher's qualitative insights into superior businesses and management, and Munger's emphasis on owning great businesses and understanding psychological biases. It's the blend. He famously separates theory, that fundamental idea that you should buy at a discount, to intrinsic value, Graham's margin of safety, from methodology, which were Graham's more quantitative shortcuts, like buying stocks at less than two-thirds of net assets or very low PE ratios.
Right, the specific rules versus the core principle.
It's exactly. He abandoned the latter when market conditions changed, noting that the 1973-1974 bear market was really the last time it was easy to profit from Graham's pure quantitative methodology. His primary takeaway from Graham was simply, I still think those are the three right words: margin of safety. It's a powerful testament to his adaptability and willingness to evolve, rather than rigidly sticking to outdated methods. Moving into how Buffett puts these principles into action, it's critical to understand his fundamental perspective. He views himself as a business analyst, not as a market analyst, not as macroeconomic analyst, and not even as a security analyst. What does that mean? It means looking at companies holistically, as if he's buying the entire operation, not just a piece of paper trading on an exchange. It's not about predicting market swings or economic forecasts. It's about understanding the underlying business, its economics, its competitive position, as if you were going to own it forever.
This profound perspective leads directly to what Robert Hagstrom categorizes as his 12 immutable tenets. These are essentially the rigorous filters through which every potential investment is considered. These tenets are grouped into 4 critical areas: business, management, financial, and market. They ensure a thorough, owner-like examination, forcing him to think like he's buying a family business, not just trading a ticker symbol.
Okay, let's start with the business tenets. The first is that the business must be simple and understandable. This isn't about being simplistic, is it? It's about eliminating unnecessary risk. Buffett famously avoids what he doesn't understand. He knows the revenues, expenses, cash flows, labor relations, pricing flexibility, capital allocation needs for all of Berkshire's holdings, whether he controls them or is just a minority shareholder. The core insight here is that true risk often comes from not knowing what you're doing.
Okay.
Right.
Right.
From venturing into areas where you can't confidently assess the future or the competitive landscape. If you can't explain how the business makes money simply, maybe you don't understand it well enough.
Exactly. Next, a business must have a consistent operating history. This isn't just looking at past profits. It's about understanding that predictability is kind of the ultimate cheat code in a volatile market. Buffett knows that while some turnarounds might seem exciting, they seldom turn into lasting successes. The true insight is that a long, stable track record minimizes hidden risks and allows for much more reliable projections. It gives you a surer path to compounding wealth, even if the business faces temporary wounds like Geico did. It's about finding fundamental soundness, not just a flashy story, because stability makes forecasting much, much more reliable.
And finally, for the business tenets, the company must have favorable long-term prospects. This means the business must possess a durable moat, a sustainable competitive advantage. This moat protects its earnings and allows it to grow over time, often enabling it to raise prices without losing customers. This could be the pricing power of near monopolies, like newspapers once enjoyed, or significant cost advantages, like Geico. It's about recognizing those enduring qualities, that deep competitive protection that gives a business an edge against rivals for decades, ensuring its economic castle stays strong.
Okay, turning to the management tenets. The first is rationality. Management must think and behave like true owners, prioritizing increasing shareholder value through rational capital allocation. This means deploying capital effectively. And if there aren't high return reinvestment opportunities within the business, returning excess cash to shareholders via dividends or stock repurchases. You mentioned IBM earlier, their aggressive share repurchases under Gerstner and Palmisano that significantly reduced shares outstanding and increased dividends that demonstrates this owner-oriented, rational approach. Buffett admires managers who don't feel the need to expand just for expansion's sake, but rather deploy capital only where it truly earns the best return for shareholders.
The second management tenet is candor with shareholders. True candor means recording financial performance fully, admitting mistakes, and not hiding behind GAAP. Generally accepted accounting principles which can sometimes obscure the true economic picture or, overly optimistic projections. Buffett's own mistake du jour section in Berkshire's annual reports is a perfect testament to this. He believes a CEO who misleads publicly will eventually mislead themselves privately. And admitting errors fosters trust and encourages learning from missteps. He demands data that helps shareholders answer three key questions. What's the company truly worth? Can it meet future obligations? And how good a job are managers actually doing?
And a crucial psychological trap is addressed by the third management tenet, resistance to the institutional imperative. This is a really critical point, especially in today's corporate world. The institutional imperative is that lemming-like tendency of managers to imitate peers. It leads to irrational actions like acquiring growth at overvalued prices or mindlessly expanding corporate domains, even if it destroys shareholder value. Buffett observed this with failed investment banking firms. Despite high IQs and hard work, they all failed due to mindless imitation of their peers. This imperative often prioritizes activity and appearing busy over sound, rational judgment, especially when faced with temporary difficulties or pressure to keep up with the Joneses. It's about conforming, even when conformity is destructive.
Okay, moving on to the financial tenets. The first is to focus on return on equity, ROE, not earnings per share, EPS. Why is that so important? Because EPS can be incredibly misleading. It often grows simply by retaining earnings, making a record EPS figure seem impressive even if the underlying return on the capital being reinvested is stagnant or even declining. ROE, however, measures how effectively a company uses shareholder capital to generate profits. Buffett looks for high ROE achieved without excessive debt because it truly indicates financial quality and efficient capital use. It shows how much profit is generated for every dollar of shareholder money invested.
Then we need to calculate owner earnings. Think of this as the real cash profit a business generates that's truly available to its owners, after accounting for everything needed to maintain the business and its competitive position year after year. Unlike typical accounting profits, which can be inflated by non-cash charges like depreciation, or money that actually needs to be reinvested just to stand still, owner earnings represent the genuine surplus. It's the critical number that tells you how much money the business is actually generating for you as an owner. It gives you a much clearer picture of distributable cash flow.
Also, under financial tenets, look for high profit margins. This sounds straightforward, but it's powerful, isn't it? Companies with strong, sustained profit margins demonstrate pricing power, operational efficiency, and often a differentiated product or service that lets them keep more of their revenue. It's a clear indicator of a strong business that isn't just selling volume, but capturing real value.
And finally, under financial tenets, for every dollar retained, ensure value creation. This is what Buffett calls the $1 rule. It states that for every dollar of earnings a company retains and reinvests, it should create at least $1 of market value for its shareholders. If a company consistently achieves above-average returns on its augmented capital, that success will be reflected in an increased stock price and higher market cap over time. If it can't, if that retained dollar generates less than $1 of market value management, is essentially destroying shareholder wealth. This reflects the crucial interplay between retained earnings and increased market value. Ensuring growth adds real measurable value for owners.
Now for the market tenets, which bring us right back to Graham's enduring influence. First, you must determine the value of the business. Value, for Buffett, is the discounted present value of a business's future cash flows, specifically its owner earnings. Price, determined by the often cyclical market, and value, determined by careful, objective analysis. They are not always equal. The market can be irrational short-term, creating significant discrepancies,
which a diligent analyst, armed with these tenets, can exploit. And this leads directly to the second market tenet. Buy at attractive prices, creating a margin of safety. This is Graham's enduring legacy, and for Buffett, it's the most critical step. He will only buy when the price is at a significant discount to his meticulously determined intrinsic value. This cushion protects against misestimations of future cash flows, unexpected changes, basically anything going wrong. It allows for mistakes. He's famously willing to be inactive for long periods, patiently waiting for the perfect pitch rather than swinging at every offering. Risk, to Buffett, doesn't come from price volatility itself. It comes from not knowing what you're doing. If you truly understand the business and buy it at a discount, you've largely mitigated the risk. You have a built-in buffer.
Okay, now let's see how these tenets played out in some of Berkshire Hathaway's most famous common stock purchases. Each has a unique story, but they all demonstrate Buffett's consistent framework in action. First up, the Washington Post Company, 1973.
Right. Buffett's deep understanding of the newspaper business wasn't just theoretical, it came from profound early life experiences. His grandfather owned a weekly paper, his father edited the college paper, and Buffett himself delivered papers and later bought the Omaha Sun. He saw the Post as a simple, understandable business, consistent operating history, and truly favorable long-term prospects due to its near monopoly in D.C. This monopoly gave it unusual pricing power, allowing it to raise prices faster than inflation, a powerful, durable moat. He understood the economics intimately.
And he bought in when the market, grouped by the 73-74 bear market, valued the whole company at just $80 million. But his intrinsic value calculation, even conservatively, was way higher. He estimated the value to be at least $350 million, potentially $485 million if pre-tax margins improved. That's a truly significant margin of safety, despite the market gloom. Katharine Graham's commitment to maximizing profit and controlling costs reinforced his confidence. And the numbers proved him right. The Post's ROE doubled within 5 years, reaching 36% by 1988, while the company purposefully reduced its debt. Strong, rational management and incredible financial discipline.
Then came Geico Corporation, 1976. Now, this seemed, on the surface, like a turnaround, which Buffett usually avoids. Remember, turnarounds seldom turn. But Geico was wounded, not terminal. Its core competitive advantage, low cost, agentless insurance allowing lower premiums, was still intact. There were still plenty of safe drivers to insure profitably. The key was John Byrne's candid and disciplined management. He aggressively cut costs, returned the company to profitability after huge losses, and relentlessly emphasized being the low-cost provider. Byrne even shared his secretary with 2 other execs to hammer home cost control. Buffett saw the underlying business was still great. It just needed the right execution.
Right. Buffett saw Geico's inherent franchise value, despite its struggles. He recognized it as a business that could be a consistent performer long-term because its fundamental advantages remained. His $1 premise played out beautifully here. Between 1980 and 1992, Geico created an impressive $3.12 in market value for every dollar retained. In 1980, the market value was $296 million, but Buffett estimated its intrinsic value at $600 million, based on its owner earnings and growth potential. Again, a substantial margin of safety, even in a seemingly troubled company, by focusing on the inherent value of the business model.
Next, the Coca-Cola Company, 1988. A simple, understandable business for Buffett selling sugar water, universally recognized brand. The key here was the transformation under Roberto Goizueta, a renewed, almost fanatical focus on the core syrup business, which dramatically increased profit margins and ROE from around 20% in the 70s to 31% by 1988. This demonstrated highly rational management, returning high value to shareholders even while investing for growth. Goizueta significantly increased dividends while simultaneously reducing the payout ratio, allowing for reinvestment without shortchanging shareholders, a perfect example of the $1 rule in action.
And Buffett paid a premium to book value for Coke, clearly moving beyond the pure cigar butt approach. But the intrinsic value, considering Coke's extraordinary level of economic goodwill, that powerful brand, and its predictable global growth, still offered a significant margin of safety. While the market valued it at $14.8 billion when he bought in, Buffett's estimates for intrinsic value ranged from maybe $20.7 billion up to $48.3 billion, depending on growth assumptions. That's a potential discount of 27% to 70%. This investment was a clear shift to paying for quality, heavily influenced by Munger, recognizing that a great business at a fair price beats a mediocre business at a bargain, long term.
Then the purchase of International Business Machines, IBM, 2011. This was initially quite surprising, wasn't it? Buffett famously avoided tech, confessing he wouldn't be the 10,000th smartest guy, analyzing them due to unpredictable cash flows and short franchise lifespans. However, his epiphany came from recognizing IBM's enduring competitive advantages in client retention, those deep, sticky relationships, and crucially, its financial management. Lou Gerstner and Sam Palmisano's brilliant use of stock repurchases significantly reduced shares outstanding from 2.3 billion in 93 to 1.1 billion by 2012 and aggressively increased dividends. This showed immense rationality and shareholder alignment. They were actively buying back value.
Buffett's comfort came from the business transforming into high-margin consulting and software, moving away from commoditized hardware, making it more predictable in his eyes. He even famously dreams of the stock underperforming, because it allows IBM to buy back more shares, which directly increases Berkshire's proportionate ownership in future earnings. He highlighted that if IBM stock averaged $200, Berkshire would own about 7%, but if it averaged $300, they'd own only 6.5%. The lower price meant more share repurchases, yielding a huge increase in value down the road for Berkshire. That's extreme long-term owner thinking, profoundly counterintuitive for many.
Finally, H.J. Heinz Company, 2013. Simple, understandable business for Buffett. Consistent operating history back to 1869, favorable long-term prospects, especially in rapidly growing emerging markets. This demonstrated his continued focus on strong global brands, recognizing their moats and enduring consumer appeal. Heinz, #1 in ketchup globally, getting over 80% of its sales growth from emerging markets leading up to the deal. Huge future potential.
And while the purchase price discount wasn't as deep maybe as some prior buys, the structure of Berkshire's investment provided a multi-layered margin of safety, showing his adaptability. They invested $4 billion in equity and $8 billion in redeemable preferred stock, yielding 9%, plus warrants to buy 5% of the common stock cheaply. This meant Berkshire would earn a guaranteed 6% annual return on its blended investment, excluding the warrants and any future growth. Even if Heinz lost money, Berkshire got its preferred dividend first and had seniority. The partnership with 3G Capital also highlights his trust in external, disciplined management to drive efficiency, proving he's not rigid about who runs the businesses he owns. Okay, let's pivot now to how Buffett manages his portfolio and, crucially, the psychological aspects that trip up so many. First, his philosophy of focus investing less is more. It's almost drilled into us, isn't it? Diversification. Spread your risk. Don't put all your eggs in one basket. The golden rule of prudent investment management. But then you look at Buffett and Munger, these focus investors, and Munger famously quips that 3 stocks are plenty.
That's a pretty radical idea for many of us. What's the hidden logic there? How does concentrating your portfolio actually reduce risk, as they claim?
You're right, it feels counterintuitive. While traditional diversification certainly reduces the chance of a big loss from one bad apple, it also significantly limits the potential gains from your big winners. It turns your portfolio into something that just reflects the overall market, more or less. Buffett believes a concentrated portfolio can actually decrease risk if it forces you to think more deeply, conduct more thorough research, and achieve a much higher comfort level with the economics of each business before you buy in. Academic studies, like those using the CompuStat database, have even shown that reducing the number of stocks can increase the probability of generating higher returns than the market, although yes, with higher volatility along the way. The idea is you become truly knowledgeable about what you own, rather than broadly exposed to things you barely understand. You're putting your eggs in fewer baskets, but watching those baskets very carefully.
Makes sense. Like Ted Williams, the baseball legend, waiting for the pitch in his sweet spot. Great investment opportunities are rare, so when they appear, you bet big, rather than making small, frequent bets on mediocre ones. But for the average investor, someone without a team of analysts, how realistic is it to truly identify and monitor a handful of perfect pitches to the depth Buffett does? Does his scale give him an advantage most of us don't have? Or is the principle still universally applicable?
That's a critical question. While his scale is undoubtedly an advantage, the principle is universal. It forces discipline. This approach is deeply rooted in probability theory and Kelly optimization. Investing, for Buffett, is an exercise in probability. He frames it as weighing the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain, unquote. It's about quantifying and updating your assessment of odds. Bayesian analysis, for instance, gives us a logical way to update our probabilities with new information. Say you value a company, then a competitor makes a breakthrough. Bayesian thinking helps you logically adjust your initial probability before acting, not just reacting instinctively.
And the Kelly optimization model from Blackjack takes this further, suggesting how much to bet based on your statistical edge. But it's risky, right? You need a long-term horizon because success isn't guaranteed short-term. You absolutely must avoid leverage, as unexpected calls can force selling at the worst time. And crucially, you guard against overbetting. This is why many use a half Kelly or fractional Kelly approach, an extra margin of safety in portfolio management, layering protection beyond the margin of safety on individual stocks. It's about knowing your edge and betting accordingly, but not so much that bad luck wipes you out.
Charlie Munger's racetrack analogy illustrates this perfectly. Find a good horse at inviting odds. Too often, investors pick long shots that never finish, or sure things without considering the payoff relative to the odds. This means calculating probabilities, waiting for the best odds, adjusting for new info, and then deciding how much to invest, always prioritizing that essential margin of safety. It's deliberate, thoughtful, not a speculative gamble, which is where most investors go wrong. They swing at every pitch instead of waiting patiently.
Okay, here's where it gets really interesting, because money and markets are inherently emotional. This brings us to behavioral finance, a field explaining market inefficiencies through psychological theories. What's truly alarming is how often we're completely unaware of our own irrationalities. We think we're rational, but our emotions, fear and greed, often steer our decisions in ways we don't even perceive.
One huge trap is overconfidence and overreaction. Investors frequently fixate on recent information, extrapolating short-term trends way out into the future, leading to overconfidence when things are good. This is often worsened by overreaction bias. People tend to overreact to bad news and react slowly to good news. Psychologists call this myopia, or nearsightedness, and investing focusing too much on immediate, volatile movements. Richard Thaler, a key figure here, famously advises, invest in equities and then don't open the mail. It underscores how frequently checking volatile portfolios leads to emotionally driven, poor decisions because you're constantly hit with short-term noise.
Building on that, we have loss aversion and mental accounting. People universally regret losses about 2 to 2.5 times more than they welcome gains of the same size. This loss aversion is a powerful, often subconscious, driver of bad decisions, and it's made worse by mental accounting, where we put money into different mental buckets, influencing how we perceive and treat it. Money from a bonus feels different than money from an inheritance, or house money from a winning trade feels different than our initial capital, even though, it's all just money. This leads to inconsistent risk-taking and irrational selling.
And the combination of frequent evaluation and loss aversion creates myopic loss aversion, a major hurdle. If you check your portfolio daily, there's roughly a 50-50 chance you'll see a loss just due to normal market swings. The longer you wait between checks, the less likely you are to be confronted with daily volatility, making your choices seem more attractive and reducing emotional turmoil. Buffett's game is quick about wanting the stock market to open only once a year aligns perfectly with these findings. He intuitively understood this long before academics formalized it. Constant noise leads to constant, costly mistakes.
And then there's the lemming factor, that pervasive temptation to follow the crowd, even if the crowd is heading towards an irrational decision. Managers, particularly, often fail conventionally because the system rewards adhering to standard practices and groupthink over independent thinking, even if independent thinking would lead to better outcomes. As Buffett dryly puts it, no individual lemming has ever received bad press for following the crowd, even if the crowd is headed for a cliff. It's a powerful incentive to conform, even if it means suboptimal performance.
This all leads to the overarching advantage that separates the truly great investors: rationality. Daniel Kahneman, a psychologist, won the Nobel Prize for integrating psychology into economics, legitimizing what Buffett and Munger understood intuitively decades earlier. That emotions, specifically fear and greed, move stock prices wildly above and below intrinsic value in the short run. They entered the business world and found huge, predictable patterns of extreme irrationality in market participants, creating ripe opportunities for the disciplined.
And that's precisely where the money is made. Rationality is essential when others are making decisions based on short-term greed or fear. Intelligence alone isn't enough. It's the ability to detach the brain from emotions, to remain calm when everyone else is panicking or exuberantly overpaying. As Buffett famously says, if you've been playing poker for a while and don't know who the patsy is, you're the patsy. The irrational behavior of others, driven by fear and greed, creates the very opportunities the rational investor exploits. It's about being an independent thinker, not a follower.
Which brings us neatly to the value of patience, a concept that's increasingly countercultural in today's rapid-fire markets. Finance theory tells us investors are rewarded for identifying mispricings. Yet, despite significant excess returns available over longer periods like rolling 5-year doubles for well-chosen stocks, most market participants today are short-term traders. The average stock holding period has shrunk from years to mere months. This almost guarantees most investors miss the significant compounding opportunities that emerge only after 3, 5, 10 years or more.
This slow migration from long-term investing to short-term speculation has paradoxically reduced the difficulty of winning short-term bets for some, maybe, but it has also significantly reduced their potential returns. The best returns are captured over longer durations. The powerful magnet drawing so many into speculation leaves a rarefied few to exploit the profound inefficiencies of long-term investing. The correlation between a company's operating earnings and its stock price becomes much, much stronger over longer periods. A 10-year hold shows a significantly higher correlation than a 3-year period. It illustrates that in the long run, fundamentals do dictate value.
And this ties directly into rationality and disrationalia. Rationality is based on reason and knowledge, not emotion, and it's distinct from raw intelligence. Keith Stanovich, a psychology professor, coined disrationalia, the inability to think rationally despite having high intelligence. This often stems from cognitive miserliness, our tendency to prefer easier, less effortful, often less accurate thinking, and mind-ware gaps. Basically, a lack of mental tools or specific knowledge for rational thought. Many intelligent people are satisfied with superficially attractive answers, stopping their thinking prematurely instead of digging deeper.
This means actively avoiding what Daniel Kahneman calls System 1 thinking, which is fast, intuitive, emotional, superficial, tragically prevalent on Wall Street. Instead, we should actively embrace System 2 thinking, which is slow, deliberate, effortful, and rational. The principles of the Warren Buffett way are best suited for slow thinking, not the rapid-fire decisions common to System 1. It requires mental work, self-control, and a profound willingness to be skeptical of your own gut feelings and the prevailing market mood.
Ultimately, Buffett's enduring, almost incomprehensible success stems from his consistent ability to aggressively invest through rough periods by remaining rational when others are gripped by fear or greed. His Buffett advantage comes from a unique, powerful blend. First, a behavioral advantage, superb rationality, incredible emotional discipline, and unwavering focus on long-term value, resisting the daily noise. He's uniquely unswayed by the market's fickle moods. Second, an analytical advantage, seeing businesses, not just stock prices. Focusing on intrinsic, cash-generating capabilities, actively seeking businesses that can profit regardless of the economy due to their deep moats and predictable cash flows. And third, an organizational advantage. Building Berkshire Hathaway on pillars of profound autonomy for managers, centralized rational capital allocation by Buffett himself, and radical decentralization in operations. His motto, hire well, manage little. This structure cultivates ownership and lets great managers thrive.
He believes the cost of turnover is human. Why disrupt value creation if you have the best businesses, run by the best people, supported by rational long-term shareholders? His personal enjoyment in his work, finding harmony between his investment attitude and personality. That's a powerful lesson in itself. He finds happiness in the work, often saying he tap dances to the office, viewing it not as a job, but as an endless intellectual pursuit.
And this is crucial. He consistently emphasizes that his method is not beyond anyone's competence, that you too can learn to apply these strategies. The true value of a business is simply its estimated future cash flows, discounted conservatively back to the present. The final crucial step is always to buy at a significant discount to that determined value, creating that robust margin of safety. It's about being approximately right in your valuation and then being incredibly patient, waiting for the market to offer you a steal.
So what does this all mean for you listening right now? It means there's nothing inherently scientific or magical about valuing a business and then paying a price below its true intrinsic value. It requires careful thought, deep discipline, and a profound understanding of what you actually own. It's about thinking like an owner, not a speculator, and waiting patiently for the market to make you an offer you can't refuse. Today, we peel back the layers of Warren Buffett's unparalleled investment philosophy. We move from his foundational influences and early formative lessons to the 12 immutable tenets he applies to every business, and crucially, to the deep psychological hurdles we all face as investors. We explored how patience, unwavering rationality, and a true business owner's mindset are far more powerful and ultimately more profitable than mere market speculation.
You now have a map, essentially, to think like Buffett, to be a business analyst, not just a market analyst, to calculate owner earnings, not just misleading EPS, to practice focused investing, not just blind diversification. But the real challenge, it isn't the intellectual grasp of these ideas, it's the profound emotional commitment required to execute them consistently. The market often presents the best opportunities precisely when it feels most uncomfortable to act, when fear is absolutely rampant. So the question for you, the learner, is this. Are you willing to be patient, rational, and disciplined enough to truly be greedy when others are fearful, even if it means confronting your own deeply ingrained cognitive biases and waiting for that perfect pitch, however long it takes?